In a recent LinkedIn post, billionaire investor Ray Dalio answers the question, are we in a stock market bubble? We'll go through that article piece by piece in a moment. But first, it's been a big week in the markets. Apple teased at their most recent shareholder meeting that, quote, later this year, I look forward to sharing with you one of the ways we will break new ground in generative AI, another technology that we believe can redefine the future. They also hinted that these generative AI measures will come out this year. This also explains the reason why they closed out their Apple car. Apple is one of my largest holdings, and I could not be more happy about this news. Automobile manufacturing is a low margin business. Period. Apple stock is down 9% since the start of this year, but it's still up 11% from a year ago. OpenAI also fired back at Elon Musk in an open letter. This is a fun read if you want to check it out. I'll make sure to link it in the description below. I'm eagerly awaiting the war between the stands of Elon Musk and the stands of Sam Altman. Anyway, back to Ray Dalio's letter. In this letter, he answers the question, are we currently in a stock market bubble? He starts off the article by describing how he identifies a bubble. And he gives 6 metrics to define that. Those 6 points are high prices relative to traditional measures of valuation. We've seen this one before. Unsustainable conditions, basically meaning that growth levels cannot be sustained by economic factors. New market entrants. This is also called the shoeshine boy sentiment, which is a funny anecdote that was actually Joseph Kennedy's, JFK's father. A really broad bullish sentiment, a high percentage of purchases being financed by debt, e.g. a lot of leverage, and a large bet being placed on forward and speculative purchases. And he kind of answers the question right away. He says right in the first paragraph that the market doesn't look very bubbly to him. And Ray Dalio has credibility here. Back in 2008, his Pure Alpha fund almost rose 10%, while the rest of the market crumbled. Next, he calls out the elephant in the room. He mentions that the Magnificent Seven does look a bit frothy, and that the market is betting that generative AI will bring a lot of revenue in for these companies. And if that doesn't work out, they're gonna be in a little bit of trouble. He then continues on to give you a full explanation of each one of those 6 things that he talked about. The first point that he goes into is how are prices relative to traditional measures? And he shows that prices relative to traditional measures have been a lot higher right before a bubble, around this 100% mark, whereas currently they're only around 73%. He does point out, even in the Magnificent Seven, that group is, in the aggregate, fairly priced. However, he does say Alphabet and Meta are somewhat cheap, and Tesla looks expensive, compared to that traditional measure of value. The third point talks about how many new buyers have entered the market. In this data that he presents, we're seeing new entrants come into the market at around the same rate we did during the 1990s bubble, but you also have to think about how conditions have changed. The markets have never been more accessible. So it makes sense that after 2022's drop, retail investors would get scared out, and now they're starting to come back in. Again, this is the opposite of what we should be doing. One of my favorite Buffett sayings is that we need to be greedy when others are fearful and fearful when others are greedy. When the market is rising is actually the time that we should not be jumping into things. We want to do the opposite. I haven't been buying really at all this year. He goes on to say that retail investors continue to play an active role in this market, but their level of activity has still come down from the COVID era highs because we have other things to do now. And then his fourth point is how broadly bullish is sentiment currently. He says that overall the market is only slightly bullish. And he goes on to point out that IPO activity can also be a good indicator for seeing how bullish the market is in general. He gives some analysis that sentiment around AI is quite bullish right now. And a pretty fun metric that he uses for that is how many times AI is said on quarterly earnings calls. This is kind of a fun way to think about trying to identify a bubble. And the fifth point he makes, which is are purchases being made by high leverage, actually looks pretty healthy. It's probably because interest rates are high, but we can see that there's not that much leverage being thrown around in the market. Now, he does call out US household margin debt as a percentage of GDP is still relatively low compared to 2020 highs. I also wonder how important it would be to look at credit card debt. I've seen that has hit all-time highs. And then his last point is to what extent have buyers made exceptionally extended forward purchases? And that's still just around the 38% mark. What he points out is that it does look frothy for the Magnificent Seven. Those large tech companies are investing heavily in the AI infrastructure that would be required to further build out the data centers to build these large language models. But overall, he says that we're not in a stock market bubble, which is really interesting. That's all for this video. Thank you so much for watching. Please remember to like and subscribe.